And good evening, everyone. John Hutchinson with Traders Reserve's weekly paycheck training webinar. Want to welcome you this evening. Thank you for taking time out of your night to join us. This is a live webinar, and it will be recorded. So there you go, Jay. It will be recorded. We'll have the recording out to you about an hour after we conclude. Tonight's presentation should run about 45 to 50 minutes, and then we'll leave plenty of time to do questions and answers with my special guest tonight. And so that you stay around as long as you want, ask the smart questions that you folks have, and we'll be ready to roll. Before we get underway, if I do want to do a quick audio check, make sure that everybody can hear me okay. This is a program that taps into Google Hangouts, so from time to time you may experience an audio delay, maybe even a video freeze. These things happen in this internet world. If that does occur, best bet is to log out and log back in, and you'll be able to keep right up with the presentation as we're going along. But as I said, just drop me a line to let me know that you can hear us okay, and let me know where you're from. We always enjoy finding out how far around the globe our webinars are reaching. So I'll let the audio catch up to you folks on that note so that you can let me know that the audio is coming through okay. And then we will get started here in just a second. Great, Nicholas Scott, thank you. And looks like we've got a really good crowd in here, so already over 200 of you. Excellent. It's going to be a good night for you folks, and I'll tell you why. And I'll let my expert really dive into this topic on his first slide, but tonight this is about producing income. We're going to teach you a safe but simple strategy to accelerate the amount of money that you produce from your portfolio. He's been doing it for over 4 years. He has helped over 1,000 investors just like yourselves to master a very simple strategy to produce the income they need from their portfolio to meet their income needs. So it's going to be an exciting night. Very excited to have everybody here. Look at this. We've got Guat from Malaysia. I hope I pronounced that right. And Gilroy from St. Lucia. And Lacey from Richmond, Virginia. Virginia is for lovers. And Henry from Arizona. Kimberly from Down Under. Welcome, Kimberly from Australia. Jack in Philadelphia. Looks like your Eagles are going to lose LaShawn McCoy. Sorry about that. And Don from Aspen, Colorado. My dad was just out there skiing a couple of weeks ago. Dave from Tampa. Welcome, Dave. And No Name from Cincinnati, Ohio. Welcome, sir or ma'am. Seattle, Washington. Manitoba. Wow, we really are covering the globe here. Houston, Tennessee. This is great. I really enjoy seeing this. Roy from I guess that's Roy High. And New Hampshire, Arkansas, Michigan, my hometown, my home state rather, excuse me, right outside of Detroit and Rochester Hills. Carrie from Utah, the Ozark Mountains. Alfred owns the Ozark Mountains, everyone. So they are now his. If you want to pass through them, you have to pay him a toll. Anthony, y'all going to teach us how to pick the right 6 numbers to the Powerball. Sure, Anthony. They're 1, 2, 3, 4, 5, 6. There you go. You are ready to go, sir. Linda from Connecticut, New Orleans, Party Town. You guys just got done with Mardi Gras, didn't you? Another from Australia, Punil. And Gary from North Carolina. Awesome. Excellent. So again, if you have any problems with the webinar as we go along, please just log out and use your link to log right back in. It does happen, and unfortunately there isn't a control that we have. But to get us started, I do need to make the lawyers happy. So in order to do that, allow me just a moment and bear with me while I read through our standard disclaimer. This is a U.S. government-required disclaimer, so for those of you folks out of the country, I guess this doesn't apply to you, but Forex future stock and options trading is not appropriate for everyone. There is a substantial risk of loss associated with trading these markets. Losses can and will occur. No system or methodology has ever been developed that can guarantee profits or ensure freedom from losses. No representation or implication is being made that using the weekly paycheck methodology or system or the information in this presentation will generate profits or ensure freedom from losses. So now that we've basically just told you that you can't make money, you're wondering why you're here, right? No, I'm kidding. That is to make the lawyers happy. And as I usually say, if you like watching water boil, grass grow, or paint dry, you are welcome to read our entire disclaimer on optionsincomeblueprint.com. But without further ado, and I would like to introduce my special guest and our income expert, Michael Shulman. He'll give a fuller introduction on his background, but if you don't know him briefly, he's a published author. He is a 30-year veteran of the financial markets as an analyst, as a trader, and as a financial writer. And he is one of the foremost authorities on producing income in these low interest rate times. So Michael, welcome. Thank you for taking time out to join us, and let's get ready to help people.
Thank you very much. Thank you, everybody, for coming. And I think John hit it on his head. This tonight is about a better and different way to look at generating cash and income, whether you want to use the cash for income or you want to reinvest it or what have you. That's what this is about. And so simply put, you are here, you're an income investor or a trader, and you may be struggling to get consistent income from your portfolio, or are you really angry, the way I was, with zero yields on bonds, dividends, and money funds? Are you frustrated by losing money trading options, or are you just hungry for a simple way to put more cash in your account on a consistent basis? And I assume, and I hope, you're hunting for annual returns of 15–20% or more. In the next 30, let's say 45 minutes, I'm going to give you a proven strategy, truly proven, that you can use to turn every Friday into an extra payday selling options. I've developed a simple-to-follow, low-risk trading strategy that can, for some of you, restore your retirement while protecting the core capital in your precious portfolio, to put hundreds, perhaps thousands of dollars of cash in your pocket every single week, and to end the income frustration we have all shared and turn your income dreams into a reality. And as I said, tonight will be 30 to 45 minutes. What you need to do in a given week to execute this strategy is but 30 minutes or less. Those who follow my simple low-risk weekly options income strategy are averaging, based on the average portfolio size we see in our surveys, over $250 a week in total income, a truly an extra payday. And in February, that strategy would have produced $350 per week in the typical pocket. That's over $18,200 per year in additional income that I will bet all of you, some of you, most of you are missing out on. And it's time to change that. First, here I am. You probably want to know who I am, telling you how much money you should be making it or not. I am a 30-year veteran of financial markets as an individual investor and eventually as a professional. I'm an author. I wrote a book called Sell Short, which is what you might guess. It's on shorting stocks, and Made in America. They're both available on Amazon. I write articles frequently for big sites, Seeking Alpha, Microsoft Money, Traders Reserve, Investor Place, and so on. And over the last 4 years of an investor advisory service, Options Income Blueprint, I've helped several thousand people, income-hungry investors, use the power of selling options to meet and to exceed their income needs. And most importantly, I've been helping people in training such as this and in other programs learn how to master this simple low-risk strategy of selling weekly options. Now you see, a little more than 4 years ago, going on 5 years ago, I had my own income problem. My wife and I have twin sons, and they were both about to go off to college. And as you know, colleges, especially the liberal arts colleges they went to, are not cheap. And I discovered the hard way, by facing this reality, I had two choices: to put a really serious dent in my retirement account, hope I could make it up later on, or create a simple, repeatable system to put cash in my account regularly without risking my core capital any more than owning an equity, the heart of my portfolio being protected. My target was 0.5 to 1% a week. Every week, market up, market down, didn't matter. My need for income was not based on the market, it was based on my life. Now, at first glance, you might think 0.5%, even 1% doesn't sound like much. Well, that's a weekly income goal. A $50,000 portfolio putting in 0.5 to 1% income per week is making $250 to $500 in cash income every single week of the year. That's $13,000 to $26,000 in annual income. Larger portfolio, you can do the math. If you could get up to 1% a week, it would be a $100,000 portfolio. It would generate over $50,000 a year in cash and income. Smaller portfolio, people with smaller portfolios or people with larger portfolios who start off with this system with a smaller account, you're not excluded. Even a $10,000 or $20,000 portfolio can use these tactics and this strategy for one thing and one thing only, to generate cash, generate income. Stick with this training presentation because I'll prove to you that this is possible and showing you that my students are already doing it already. They're doing it right now. Today, this week, last week, the week before last, and every week for the last 4 years since I began teaching people this strategy. And that blue bar up is from our site, and those are the results, just the facts, ma'am, of the last 4 years. In fact, I want to offer an unsolicited quote about the validity of selling options in this strategy. This is well worth the money. Hard to believe how good this is. I started with $200,000 and now it's $300,000, and that was unsolicited email. And I hope I suspect I have your attention now. Well, that's a good thing. Yes, one of my students who's grown his portfolio by over $100,000, and I met some people in seminars in Florida that I give in person a couple of weeks ago, been with me, all telling me about different stories, including one person who just bought a house in Michigan to be closer to his grandkids. And how did they do it? They did it by selling weekly options and occasional monthlies. Yes, I said selling options. Now you're probably saying, hold on a moment, before you run off thinking, oh no, I've lost money with options before. Yes, most people who buy options do lose money. 80% of the time, actually more, as they expire worthless. But think about this for a second. If the options buyer is losing the money, who's making the money? The options seller is making the money, and a lot of it. Most option traders, even weekly option traders, do it all the wrong way. They're trying to hit a home run, right? That's why you're an options buyer. That 100% or 300 or 800% winner. How do they think they'll get that home run trade? They buy an option. But here's what the option buyer is really buying. Their right to spend capital in the hopes of getting a profit. They're buying risk at the expense of reward. They're buying insanely ferocious time decay, which I'll explain in a moment. And best of all, they're buying options that expire worthless actually more than 80% of the time. Yes, I just said what I said. The best of all is they're buying options that expire 80% or more of the time. Why is this best of all? Because it means the option seller stands to profit 80% of the time. The right way to trade weekly options is to sell them. What happens when you sell an option? You get instant cash. The buyer literally hands you money so you're now managing your existing profit, while the buyer is left to manage the risk of owning an option. And what happens when you sell an option? You get the advantage of that insanely ferocious time decay. Weekly options expire at the end of each week. At the end of this week on Friday, March week 1 options expire. In a moment, I'm going to teach you specifically how to capitalize on time decay so that you too can let that work in your favor and against the options buyer. So exactly what happens when you sell an option, you get to exploit the 80% of buyers who see their options expire worthless, which means the odds are in your favor 80% or more of the time. When an option expires worthless, you, the seller, you just keep all the cash that you got at the time of the transaction. And there's a bonus here. Many online brokers won't even charge you a commission to close a trade under a nickel, and there's no charge when something expires. So to recap, what happens when you sell an option? You get your instant cash. The buyer is paying you. It's your cash immediately. You're transferring risk. You transfer the risk created by time decay to the buyer. You're protecting your capital. Selling a put creates no more risk than buying shares at the strike price of the put. And it's simplified trade management. When you sell an option, you're managing money you've already made and put in your pocket. The buyer is the one managing the risk. So, please, just as we get into details here, remember, stop swinging for the fences in those home run trades, at least when you're looking for cash and income on a consistent basis. This will put you on track to give yourself an extra paycheck every Friday. And as I said before, over the last 4 weeks, in February of 2015, my followers took in $509 per week using this strategy. Selling options for consistent income is a viable and safe way to put cash in your pocket, even with that target of just 1.5% per week. Now, let me recap again. Most option traders speculate by buying options. I sell them, you sell them. We don't speculate, we accumulate cash and lots of it. We sell risk in return for cash. Those option buyers are buying risk and giving us their cash every single week. And as you'll discover, they'll give you their cash too. In the next few minutes, I will show you my strategy and how you pay yourself that 1.5 to 1% a week, once in a while even more, in cash income, selling options each week, every week. And when you learn this simple, repeatable strategy, you'll get the thrill of giving yourself an extra paycheck that you control, that you're in charge. You're no longer waiting for a dividend check or a stock to go up every single week. It's how my wife and I put our 2 sons through college, and I'm proud to say they graduated this past year, and they're now collecting their own paychecks. Still wondering how hard it might be when we get into the details, selling options to generate cash? So let's go through some specifics. What are weeklies? Selling weekly options are no different than selling monthly options, except for their duration. The majority of weekly options exist for just 1 week, expiring at the end of each week. On more liquid stocks, on larger cap stocks, and more frequently traded stocks, weeklies may open up 2, 3, or 4 weeks in advance. My approach is to sell options, a weekly option, during the week that they're scheduled to expire. For example, today in one of my services, an alert went out in the middle of the week to do something, and in 2.5 days that option will expire. And also, on the 3rd week of each month, options expiration week, it means that every option, even monthlies, become weekly options. A few key points. Now, in order to sell a put option, you must have the capital on hand as collateral in the unlikely event you are put the shares. In order to sell a call option, you typically must have 100 shares of the stock held in the event you're called out. To generate your weekly paycheck, you really should have an account working at this of at least $10,000, preferably more. And yes, you can do this in an IRA. And the highest premiums and the largest amount of cash produced occur when you sell an option, not when you use other inconsistent option strategies that bounce you around like a yo-yo. Here's a reminder as we get into more detail. As I said before, more than 80% of all options expire worthless, which means the buyer loses all of their money. And as the seller, you keep all of their money. And the value they have bought decays every hour as expiration approaches. When you sell an option expires worthless, you're paying a 0 commission to close out the trade. Only 1 commission on a trade when you sell them. And that, especially for people with small accounts, really results in a very powerful cash management strategy. Bottom line, you should be selling options every single week and racking up extra cash because of these advantages. Instant cash, lower risk, and fewer commissions. Let's give it some specifics. Meet your new friend, time decay. Time decay is the enemy of the option buyer when a stock is not moving, but time decay is the great friend of the option seller. As you can see, if you sell something as we near expiration, the time decay accelerates. Fewer and fewer people are willing to pay in the hope that the option will produce a positive return. Now, is this a narrow universe of options, of weekly options? Do we have to search for weekly options in a very difficult way? No. When I started doing this, there were fewer than 50. There are now more than 400 stocks, ETFs, and indices that have weekly options on them. When you're looking for an option, you're looking for some volatility. You're looking for a stock, and this is a big name, General Motors, that moves up and down, even if it's in a narrow trading range. That up and down movement and those gaps in that chart you see create tremendous volatility relative to other stocks in the market, and that volatility in turn creates premiums and profit. Technically, a lot of the things that traditional option traders use that are called Greeks and implied volatility and delta and parabolic this and that don't apply when you're selling weekly options. They're immaterial. What you really want to do is take a look, where does money flow in? Look at the 3-day chart, the 5-day chart, the 10-day chart. You want to see where money is flowing in, and that will tell you pretty much, and this chart bears it out, how a stock will behave in a very compressed period of time. You're looking for liquidity. You don't want to sell something where there's a big difference between the bid and the ask because only a few contracts are available. You want to find something with a large number of contracts available. And you have to decide when to sell. In my own portfolio, because I do this for a living, I can often sell a put or a call more than a week in advance. But typically, when I'm trading for short-term transactions, I'm doing it. I've picked a day, usually in the middle of the week on a Wednesday, sometimes a Tuesday. And, of course, you have to look for premiums. You want to be able to sell something that is going to generate a certain amount of cash that helps you hit your income goal, your income target. When you sum up different ways to manage your weekly option position, you can sell and manage weeklies expiring that week. You could, if you have a different perspective, sell weeklies that expire any of the weeks in the future if there's more than one week listed. You can, and I've done this very successfully in one of my services, you can sell monthlies with the plan to close that monthly option early. For example, you may have sold a March option that expires 2.5 weeks from now. You may have sold it last week. You may have closed it this week. That is the equivalent of a weekly option. It fits into this strategy. You just have to make up your mind what your target price is when you do this. And of course, you can day trade. You can sell a put and buy it back, sell a call and buy it back. And to me, that kind of trading is within a 24 or 48-hour window. So you're probably wondering, does it really work? This is all abstract. Oh yeah, it works. But it starts not with the way many systems or groups of tactics with charts. It starts with stock selection. Not charts, not Greeks, not parabolic, hyperbolic, this or that. Great companies, great stocks, and options with great premiums. This is what you need to look for. We're in a stock picker's market. I get emails, people worry about the indexes. We're in the most stock picking friendly market shown by the data in 25 years. The data shows that more stocks now than at any time in 25 years are trading in a given period of time independent of the movement of the indexes. So when you get that company right and the stock right, you can even trade more aggressively to generate even more profits. So let me repeat, this is critical. When you believe in a great company and stock, you can be far more aggressive, selling puts very close to the strike price, and therefore generating those 0.5 to 1% per week returns, those very large weekly paychecks. So let's walk through some recent weekly option trades I recommended as part of one of my services, Option Income Blueprint. Here's the company, Skyworks Solutions. These are the typical headlines if you Googled it. But it's, even though this shows a lot of momentum, this isn't a momentum stock. This is a very real company. They specialize in making the RF circuitry that's used in a lot of devices, including the Apple iPhone 6 and a lot of competitive products. And they're just sort of knocking it out of the park in terms of sales. So an alert went out. This is the way we do it in the service. If you created your own bullpen of stocks that you look at, maybe you keep a series of notes for yourself with these kind of points. You take a look at the price point. Here we have a typical series of the things that you do. And to sum it up over here, this is what the trade does. You get instant cash. Yep, you're going to get $65 a contract as soon as you sell it. Takes 1 second in my broker. In that same second, you have transferred risk. You have the cash. The stock is in a long-term untrend. The risk is now on the buyer of the put. Capital management. In this case, you would need, because it was an $81 put, controls 100 shares, you need $8,100 in capital in the very unlikely event you'll put the stock if Skyworks Solutions closes the week below $81. And we don't have time for it tonight. There are tactics, specifically something called rolling, where this just doesn't happen. In a $10,000 account, this would mean one weekly option generating $65 in cash before commissions. When the option expires worthless, as in this case it did, you produced a 0.8% return in capital in 3 days. Now, this is a higher capital required example. Many examples, of course, recent trades would include stocks such as Corning, which is $24 a share. So, recapping Skyworks, trading at 81, you sold the $81 put, you collected 65 per contract, or 65 cents was how it showed up in the option chain. You put up 8,100 in capital. You're putting it up. You're not spending any money. It's sitting there as cash in your account. No, unless you're trading in a margin account where you might use margin. It closed above 81 on Friday the 6th. The trade expired worthless, which is exactly what I hoped it would do. And you kept the $65 excluding the commissions. Now, this is just one trade. If you had a larger portfolio, imagine the cash from 2 or 3, 4 trades a week or larger positions where you're doing more than one contract. Now, you may be wondering, can you do this every week or at least on a regular basis, or was this a one-off? Of course, the answer is yes. These are the February closed trades. And let me be very specific. These are all the closed trades. This wasn't cherry-picked. These were from that service I spoke of. These are the trades. These numbers represent what would happen if we sold 3 contracts. And it's a range of capital that you would have had to put up to do 3. You can do your own math if you wanted to just sell 1 and figure out what it meant. But these are the trades from the month of February. Nothing has been left out. And this is the annualized rates of return. This is how you, when you go home tonight, you have to measure opportunities and measure your success against your income goal. If you want to do 20% a year in income off of your portfolio, you need to know, will that transaction get me there? So you do a calculation, and the rate of return is simply the amount of money calculated for the week, the absolute rate of return, which was 0.8% in Skyworks, and you multiply by 52. It's very, very simple. The month of February, which was not a whiz-bang month for the market, it wasn't anything special, average annual return of 40.75% and average weekly return of 0.82%. This is a little above average from, let's say, the recent experiences of the last 12 months, but it's pretty close to if you're a constant, consistent trader of weekly options, what you can experience. So let me get into more detail about how we pick our stock. You should be picking stocks and so forth and so on. Why Whole Foods, for example? It's the best in class by an order of magnitude. There are only 2 national grocers that are publicly listed that score at the top of Consumer Reports and J.D. Powers and those guys. The other one is Publix, which is only in 5 states. The whole world is moving towards organic food. McDonald's announced today that they're going to be using more and more antibiotic-free chicken. And if they're doing that, you can imagine how the world has shifted. There was a complete rebound in the stock based on the fundamentals of the company from a sell-off in 2014. The stock is moving due to investor sentiment, not traders. And as a side point here, I like to view people who sell weekly options for income and focusing on stock selection first as investors who trade. It's a hybrid approach, and it's extremely good way to approach the market. There was very strong short-term volume support in the $55.50 to $56 range and great premiums on the weekly options. So it was a simple trade. We sold a $56 put expiring on a Friday, generated $50 a contract. The absolute return was 0.89%. It was a 44.6% annualized return. In this case, I used 50 times a year, not 52, which is what I usually do. We all have to take a vacation now and again. And we just don't sit back and work with a handful of companies. You don't need to. I don't. You should not. There are times when opportunities arise because of things such as the fall in the price of oil. With the price of oil, I thought like an investor, but created positions like a trader, meaning many oil stocks, the baby were thrown out with the bathwater. They were very good companies. So we did what is known as a buy right. We bought the shares and sold the calls for a company called Tesoro, an independent refiner in the Midwest, Southern California refinery, and Pacific Northwest. They're using more and more fracked oil, and they have published how much more fracked oil they will be putting into their refineries rather than Gulf oil, and it's much lower cost and it's higher quality, and this increases what are called their spreads and their profit margins. The stock's been on a tear, fabulous, fabulous premiums, therefore fabulous potential for profit. You trade it like an investor, you profit like an income trader. Now, that's another example. That had a spectacular return, and we're going to go in more detail on that trade later. But I thought you might, as long as you were kind enough to come here tonight. These are some of the stocks that I like right now, and you can see I sort of put my capital where my mouth is. I own all of these. I think this list, and I'll keep on the page for a few seconds in case you want to write it down. Apple, American Airlines, a great, really seriously undervalued stock because of the U.S. Air merger and the price of oil. SanDisk, which popped today actually because of product announcements. Tesoro, best refiner in the United States and the best performing refinery stock over the last 5 years. Blackstone is the #1 private equity firm in the world, in my opinion. and a huge money manager, the largest owner of residential homes in the United States also. Gilead, by far the best biopharma company on the planet. Trading, it doubled. It's a multi-billion-dollar company with a huge market cap, and it's trading at a 50% discount to the S&P 500. General Motors, we all know, and Grubhub is a relatively new disintermediating company that is in the takeout food all over the country business in terms of supplying menus and connecting little restaurants with buyers, and now they're going to get into the delivery business itself. With these and many other names, not only is the option selling strategy simple and repeatable, it is so effective that when we do surveys, 93% of my followers who use it, they make money with it. And if this all sounds too good to be true, and frankly, sometimes when we get the statistics, it appears that way to me, but one student of mine, just as an anecdote, it confirms that 98% of the trades make money. And again, this was unsolicited. Since I started with your service, I've made 97 trades. 96 have been profitable. Thank you. And this is what can happen for you when you sell options week by week, 1.5% to 1% a week, no gambling, no shot for home runs. This is what can happen. That's how successful you too can be. And it's why I believe selling weekly options has to be part of every investor's toolbox. Remember, please, 0.5% a week is 25% a year. And as you can see by the numbers, you can do much better. I have 2 more weekly option trades I want to walk through because that's sort of what you're here for. But before that, I want to show you how you can get started immediately, like very soon, selling options for that extra income, that extra paycheck every week. As I said, I believe selling weekly options should be part of every investor's toolbox. And that's why I've created a complete training program on selling weekly options so that investors and traders with any level of experience can start paying themselves regular, consistent income from their portfolios. So tonight, I'm going to do something I rarely do. It says never. I rarely do this. I'm going to make you an offer. I'm going to teach you the complete selling weekly option strategy. What a face. In my 90-minute online training program. I will teach you the exact steps you can use to put hundreds of dollars of cash in your pocket every single week. This training program will show you the right way to select stocks and sell weekly options for instant cash every week. It's 4 keys to selecting the right stocks that have weekly options that help create the extra cash payday. There's a 5-point checklist for picking the best contract and the best strike price once you've selected the stock. And there's a ridiculously simple and quite profitable way to prevent losing trades. Along with this, you're going to get some materials. A companion strategy guide called Selling Weekly Options. A series of cheat sheets on things to do and to put down on your desk alongside of you if you're completely new to this. All of the training slides, obviously, from the training session. And, of course, a full recording of the live webinar so you can watch it over and over again. And when you complete it, you're ready to go. I mean, you should have enough understanding to be able to walk away with a complete strategy to start paying yourself that extra paycheck every Friday. Now, you'd probably expect to pay a lot of money for this, and maybe you should, but it's $250, $100, $49. You can take a look what kind of money is you're willing to spend for this training. But today, my live Selling Weekly Options training program is available right now, this week, for the outrageous price of $7.95, and that's not a misprint. It's $7.95, and there's no catch, there's no tease, there's no restricting access, and it's all yours for $7.95. And what you get is a misspelled name on the upper left-hand corner. This is an older slide. Remind me to talk to my graphic artist. There's no C in my name. You'll learn my complete strategy. You get the cheat sheets, the companion guide, plus the private website. So there's a whole potpourri of things that you can use to really come up to speed and be able to create that extra paycheck every week. And there's a recorded version of live training and QA sessions. Watch as often as you want. And again, the PowerPoint is downloadable. So $7.95. That's less than the cost of 2 double lattes at Starbucks. And if you hear the dog barking in the background, like many of you, I'm in my home tonight. So my regrets if it's distracting. And actually, I was just thinking those are lattes, but you should try the new flat white. So let me make this a very simple choice for you. You can risk going it alone, either with a very, very low yielding bond and dividend strategy that's producing very little, or CDs and savings accounts which are producing even less. This is something really bad, and it's something that was the basis of my creating this program for myself 6 years ago and making it available to the public 4 years ago. You can risk going it alone, or you can learn a very simple, a very safe strategy, no less risky than owning an equity, that right now over 1,000 income-hungry investors are using. Over the course of time, several thousand have used, to put cash in your pockets every single week. And again, unsolicited email. This year my trading account is in the black for the first time in 10 years. Most of it due to your strategy and training. I've placed 14 trades, selling puts, and have 100% positive trades. Notice that the notion is not 100% gain. It's 100% positive trades. The win rate over the last 4 years is 99%. That doesn't mean we made 99% return. I think last year the average transaction returned 29.9% when people use this kind of strategy. But the idea is not to lose money. The idea is to preserve capital. The idea is to get that 1/2 or 1% a week and just do it week after week after week after week. No speculating, nothing more risky than owning an equity, and just going after the wins. A bunt single, a single, maybe an occasional double. Forgive my baseball illusion, but it's pitchers and catchers right now down in Florida. If it's actually, I think the game started. So the bottom line here is if you're still struggling to get consistent income from your portfolio, if you're afraid of the low interest rate environment that's wrecking most income investors who haven't taken initiative to come here tonight like you have, to become more aggressive and to get more comfortable with new tactics, please learn this simple, powerful options trading strategy. It'll be the best $7.95 you ever spent. And it's to master a simple strategy that theoretically and in reality both will pay you back every week for the rest of your life. Now, it's up to you. There's the link to go get started immediately. And what I want to do now is, as you're thinking about it, I want to walk through a couple more trades. And I do look forward to teaching you, to working with you, to making things happen for you. And we're going to have Q&A in a few minutes. But what I want to do is walk you again to remind you. This is sort of the glue, just in case I went too fast and just in case you're trying to figure out if you can do this. Remember, this is the result of people taking the training program. Let's get back to Tesoro. The trade I alluded to in February was a different one where we bought shares and sold calls, and were called out, and it was an extremely successful trade. It's an independent refiner. I know the company. I know the stock. Great, really fabulous company. So in the middle of the month in January, we sent an alert. Now the stock, by the way, to show you the value of stock picking, in January week 2, we told people to sell a $70 puts. The stock closed today over 90. This is with the price of oil going down. So stock picking works as the basis of this. So an alert went out to sell the Tesoro January week 70 puts. And this is a little hard for you to read, but when you are writing your own alert for yourself, or if you remember my service and you were reading this, what you're looking at is, okay, what's the company, what's the stock? When do they expire? This was January week 2. It expired on the 9th, so this alert went out on the 7th, on a Wednesday. The entry price was $45 a contract, meaning 45 cents a share. And just like you should at home do things a certain way, I set a range. The range was try to get 45 cents or $45 a contract, but 35 should be fine. Don't go below 35. And what's the current stock price? It was $71.97. It was almost $2 above the strike price of the put. Of course, you got to put up $7,000. You didn't spend it. You're just leaving it there in your account to support each contract. And the target price here to close was 0. I wanted these. You would want these if you put this trade on and you're doing your research and you found Tesoro and you made the trade. You want it to expire worthless. You don't want to pay the second commission. You just want everything to go away. And the potential annualized gain here was 32%. And here's another way of looking at it. I just walked through that writing, but this is a simpler way you can absorb all this. The stock went up. It went from 71.97 to 72.86. It went up about $1 in the 2.5 days. The trade expired. People in this trade, such as myself, made a $45 gain on each contract. It's that simple. It's you look, the stock price that you click, you sell. It's no different than selling shares. It's a very, very, very easy process, and online brokers in particular make it extremely easy to do. Here's another one. You notice they're both related to oil. I wanted to give you these examples to show that this is not abstract. This is not some pedagogical training that is ignorant of the real world. That, you know, I can imagine a training program and you call customer service and they go, no, you can't do it now because oil's going crazy and you have to stay away from the energy sector. That's nonsense. When you're picking stocks and you're looking at companies with fundamental value, you can use this 52 weeks a year. So Southwest Airlines is a legendarily efficient operator. Business was very good, and they're known to be very aggressive in managing their jet fuel costs. So in January, towards the end of the month, oil prices are moving around here, there, and everywhere. We did this, and rather than read the alert, I'll go right to the recap. And it was trading at $41.80 on January 21st, which I can only assume was the middle of the week. We sold the week 4 $40 puts. Again, because of the bouncing around of oil, we could stay far away from the strike price and still collect a very hefty premium, $30 a contract. If you'd sold 3 contracts, that's $90, and it would have been $12,000 in capital. A fairly average trade. I think people that I work with and people that I've coached, they dibble, they dabble, whatever, and they usually start with 2 or 3 contracts a trade, or have multiple positions, 5 open at a time, of weeklies and monthlies together, and they're doing 2 or 3 contracts at a time. The stock popped. I told you, stock picking works, man. It just $45.78. The stock was up almost 10%. The trade expired. We kept the $30, and if we'd sold 3 contracts, you have that $90 paycheck. One last one, because I made the allusion to the flat whites, which are really kind of cool. They're kind of expensive, though. They're a new product that they're pushing. And this was to sell the February 87.50 put. And here I'm sort of giving you a peek behind the curtain of if you were at your desk and you were part of my service or someone else's, you get an alert. The alert shows up, you click, you open, there it is, and there's everything you need to know to make a trade. You can do this for yourself. You take notes, you put it on a piece of paper, you take the training program that you're buying here tonight, you take a look, and you just take a look at what's the trade, what do I have to do, when do these expire, what's my entry price, what should I get if I sell this, what's the current stock price, how much capital do I have to put out, how do I want to close it? I mean, how do I want to close it, and what's my potential return? You know, what am I going to do? Am I going to make a lot of money? And the bottom line here was I closed this early. If you take a look at the dates, it's January 23rd. This was a monthly position, but I intended to close it early. So if you look down the bottom and said, I want to trade 50 times a year. So here, if you were doing this on your own, independent of me, you're going, I had a target price. It was originally 0, but man, the stock moved. It just really, really moved. I sold it hoping I would make my money by the 3rd week of February, but it's absolutely flown in 5 days. So I'm going to close it out early. This is the example of how you turn a monthly into a weekly. So I'm trying to leave you, this will be the last example, of how this just doesn't apply to weekly options. This whole tactic of creating paychecks week by week also applies to when you're doing monthly positions. It's a very important thing to leave you with as a reminder that you should be, if you take the training program and decide to do this, you have to actively manage what you're going to do. So to that, here we are. That's this. I'm going to go, and I'm going to substitute for John for a while until he comes back, and I'm going to start reading some questions, and I'm going to try to come up with ones unrelated to the service, and there are a lot of cynical questions. What's the catch? There's no catch. So without speaking, I'm just going through the questions as they come in. There's no catch. It's a $7.95 program, and when it's done, it's done. You watch the recordings, you get the materials, and if you never want to do another thing with either me or with weekly options, or you want to do weekly options on your own, there is no catch. It's just $7.95. Question about the alert service, you just can go to optionsincomeblueprint.com, and I'm not a marketing guy. I assume there are buttons there that you can click on to do a trial, or you can call an 800 number for customer service. if that's what you're interested in. Let's see. So with this win rate, if you bought calls at those strikes rather than sell puts, you'd probably have annualized 1,000% returns. It's very possible, but please remember that if a stock doesn't move and you've sold a put, then the put expires worthless and you made money. If you bought a call and the stock doesn't move, then your call expires worthless and you've lost money. I know for a fact that my longer-term subscribers often do the trade, will take my direction, because I've had significant success in stock picking. It's what I've done my whole life. And they've used the direction of my trades. Sometimes they put on a put position, sometimes they buy the shares and sell calls, and sometimes they buy calls, depending upon how much speculation. This is about income generation and cash generation with a conservative approach based on protection of capital. Everything is protection of capital first. So theoretically what you said is true, but it's not something I would recommend. So we have a question. Describe a scenario how it would affect financially when your strike price is actually achieved and the trade favors the buyer. Do you simply lose the amount you would make in commission, or do you have to buy and sell the stock to the option buyer? That's with a call. I mean, if you sold a call, yes. You can't sell a naked call, and if you sell a naked call, you're out of your mind. This is from Tarrant. If you're selling a put, a $40 put, and the stock goes down to $39.50, what I do is called rolling, and in fact it's a formal industry term that you can find on a website. My broker screen says roll. You buy back that position and you sell next week's. And last year there were 85 open and closed positions, meaning positions opened in the same year and then closed in the same year. 83 were wins, 2 were not, and they were both CRE, the LED company, and excuse me, something happened here. Something happened to the screen. Let me put it back up again. Sorry about that. And what you do is you roll, and if it's only minor, you're usually out in a week, maybe 2 weeks, but usually a week. I know that last year I think we had 6 or 7 weekly, not monthlies, but weekly positions that required rolling, and we were out of all of them within probably 3 days, on average 3 days, and it might have been a little bit longer for 1 or 2. The CRE position was pre-event, so when I put out the alert, people were told that it's a whatchamacallit, it's a higher possibility of having a roll, but that's what you do, and rolling is far more efficient and far more profitable, for example, than doing spreads. Let's see, I'm trying to go to questions here. If this put does not expire worthless, couldn't you lose a month's premium gains in one trade? I don't know. I'm not exactly sure what. No, I mean, it goes back to the question of rolling. Meaning, if you sell a put for $1 and it doesn't expire worthless, you can buy it back for anything below $1. You know, forgetting commissions for a second, or you roll it into the next week or the next month. You generate more cash, so you're not only protecting being put the shares, you're generating more cash at the same time. Let's see. Do you enter the trade on the same Friday as the option expires, or do you enter on Thursday and hold to the following Friday? I assume that's a question about weeklies that are more than a week old, meaning like General Motors, you can sell a week 2, you can sell a week 4. You can enter those at any time. It doesn't really matter. I prefer trading in the middle of the week, sometime between the middle of the day on Tuesday and the middle of the day on Wednesday, that expire on Friday. I've been through other programs of Michael's previously as well, and that's an ad. Well, I might as well brag. It's well worth $7.95. You have interest. Since an option, worst case scenario, get put the stock. Well, here's the rub. Someone goes, the worst case scenario here is that you'd be put the stock. What's so wrong about being put shares? I make jokes all the time that and I did this in my seminar. I had people laughing. There were 50 people that I've worked with sitting in a room, and the bottom line was I teased them that you talk about being put shares is the same time as getting a root canal without Novocaine by Darth Vader. I mean, and being put shares is hardly a problem. When you're put shares, it means you own at the strike price that you're willing to set the put at, and then you turn around and you sell calls. And let me give you an example, an extreme example of the CRE event trade. We sold CRE puts that blew up. The only trade that did last year because it was a pre-event trade and the earnings disappointed Wall Street. It didn't disappoint me. I was disappointed in Wall Street's reaction. We accepted shares. We sold calls. It took it took more than a couple of months. It took a few months, but we're back above break even. So it's a whole methodology of preserving capital. But that doesn't happen with weeklies. That was a monthly, and the CRE was an event trade. I don't have a memory. I have one memory of a U.S. Steel weekly position 3 years ago, 2.5 years ago, that didn't work. Otherwise, the weeklies, and that's why you like weeklies. They're very flexible, very easy to manage. It's very easy to roll. You roll into the next week, perhaps 2 weeks, and you just get out. The best example of that, unfortunately, it's built around a terrible tragedy, is I had recommended selling an American Airlines put the day before the Malaysian airline went down when the Russians murdered all those people on the airplane, and so everything fell apart among airlines. The reflexive trader, who I call the lemmings, they're also idiots, who immediately traded in and out of this stuff, whacked it, and we rolled it. Because of the volatility that happened with the incident, premiums went sky high on way out of the money puts. We rolled the position, increased our profit, and had a fabulous profit. We were out of the position within 3 or 4 days after that Friday. So even in a thing of a geopolitical event, remember, if there's a sudden untoward event, premiums are going to go up and you stand a possibility of making more money. Perry asked, no, that's someone else. Since an option buyer has the right but not the obligation to buy the stock, where am I? At the target strike price, what if the buyer chooses to exercise their right? If you're talking about calls, well, you lose the shares. So if you own Apple, and like I did, and you sold a $120 put and the stock goes to a call, and the stock goes to 130, you either roll it forward, which in calls it's always profitable because it means you're moving it out to a further date, and you're making money because you're moving up to a higher stock price. You get called out, or you can manage the position so you don't get called out. It's not part of a weekly training program, but when you're rolling calls forward like that, you should always try to capture some of the appreciation in cash simultaneously. But yes, you would get called out. Let's see. How is the price for the Blueprint monthly? There's a $79 trial program that you get 2 or 3 months, and then there's a yearly and a monthly offer. I think it's $79 a month after the trial period. So the trial is either 2 or 3 months, and then this is for the service. And that's I'm answering a question, I'm not advertising. And then it's $79 a month or $697 for the year. Why no spreads? I get this question all the time. Spreads are, for those of you who are familiar with them, you're talking about taking 2 positions in one transaction, and they're designed to limit your risk in the individual transaction. Understandable. I focus on stocks and companies where I'm willing to do multiple transactions to make the entire series of transactions a position that is profitable. And based on 4 years' experience, rolling is far more profitable than spreads. Now, spreads stretch your capital. The beauty of spreads when you do them is that you put up far less money in terms of capital, and that's why most spread traders use spreads. I don't object to spreads, I just don't do them in the service. I know that many, because from my emails, that many of my subscribers, and if you do weekly options, you can go find a spread training course if it's interested you somewhere else. I don't do it. Many people who do these options, who sell weeklies or sell monthlies, they'll take directional advice from me and they'll turn it into a spread. They'll do both kinds of trades. So now I'm going down. When is the training? I think that after you sign up, or if you go to the page, the link, it's in the administrative notice. If you go to that link, it has all the details. Do you send an alert on how to fix a trade if the stock suddenly drops below the put sold? This is related not to the training program, but to the service that I do. And that tonight is about the training program, but the answer is yes. All the positions recommended in the actual service are actively managed, and there are alerts for every single possibility. Nobody gets left alone. If weeklies are good, why not do it Friday before so you get 2 extra days to I sell my own weekly calls the Friday before. The question was, if weeklies are so good, why do you do them in the middle of the week and capture a certain amount of premium instead of doing it sooner, let's say 2 or 3 days before, and capturing even more premium profit? The reason, of course, is with 2.5 days exposure to the market, you have 2.5 days exposure to possibly being wrong. If you do it the week before, you have 5, 6, 7 trading days of being wrong. You have a trade-off. You have more possibility of having to roll the position. In my own portfolio, I sell calls, weekly calls, on the Thursday or Friday before the following week, because I don't mind if I'm called out. If I'm selling it, I always sell, of course, strike price above the cost basis. So when you're selling calls, we mostly sell puts and options income blueprint. We occasionally sell calls, but the bottom line is this is mostly about puts. But if you're selling calls and the call's above your cost basis and you don't mind being called out, then sure, sell it earlier and catch the premium. Let's see. I'm trying to roll down here. Keep on going. This Google Hangout keeps on popping me up. Do you own these stocks because your options moved against you and you were forced to buy them? No. I pick stocks first that I sell calls against. The stocks that you saw that I own it come from. Let me step back for a second. I create a bullpen for my services. This is training, but for the stock advisory services, I have what is known as a bullpen. It's 25 stocks that are typically 2 or 3 change a quarter. Some of them have been there forever, and they pretty much line up with what I do in my own portfolio, meaning I don't own 25 stocks. I think I own 11. But it's the same criteria. Great long-term companies. These are growth stocks, and very, very rich premiums on the options. So it's the commonality of my own stock picking then goes into the bullpen. But let's see, how many trades do you get with your service? Last year we did 90-something trades. 85 were open and closed. There was a spillover effect from the previous year in December going to January. So it was 85 trades that were open and closed in the same year. I think we put on either 93 or 97 positions, and that doesn't include rolling. So if you rolled a position, that's not considered another transaction. It's considered the same trade. So it's on average about 2 a week. We've already done 2 this week. We'll probably do 3. Last week we did. It depends on the market and it depends upon how certain stocks are doing. It also means there are 2 weeks. There are 3 weeks a year that there's no 2 weeks a year there's no trading. I'm just not available. Christmas week and usually. So really, it's roughly 1.9 to 2 trades per week. But I've accelerated it because of market conditions, especially because of oil. And because the market's in a tight trading range between 1985 and 2085, because 2100 to me is the same thing as 2085 in the S&P. Because we're in a tight trading range, it's an ideal time to sell options, to sell puts. So I've been a little bit more frequent this year. Do you own these? No. Let's see. I have entered the room based on time clock run down to 0. What are the trading fees? The stock. Won't the trading fees eat up your profits? If you have a tiny account, let's say it's a $10,000 account and you're trading 1 or 2 contracts at a time, you do have to be mindful of your commissions. You have to find a low-cost broker, and there are plenty. And you really, weeklies are better for you than monthlies because logically you're going to let them expire, and you don't have that second commission. But you could do a contract for $3 or $5. Selling one contract, let's say on a $50 stock. You sell 2 of them, it's maybe a $6 to $9. You're collecting 50 cents or $50 a contract. It's $80 to $100 a contract, $80 or $100 cash coming in from that position. You're paying $8 to $10 in commissions. That's no problem. And Linda asks, if you get put the stock, would you then sell calls against the stock? Absolutely. Absolutely. If the share price has not crashed, even if it crashes, Linda, you sell calls. You just have to manage them actively, and you roll calls forward. In the service, by way of example, I do about 1 event trade a quarter, meaning before earnings. And Whole Foods a couple of years ago, I got the earnings right, but Wall Street disagreed with me. It's a funny way to put it. And I got put the shares at 60, and the stock went down to 35. I averaged down in my own account and sold calls. But the service itself, for people who hung on, it's a break even. Now, it took a long time, but we lost no capital. So what you do is you have to, when you put shares and it's well below your cost basis, the trading price, you just have to sell calls and actively manage it. Let's see. Don't great companies tend to go up, not down? If you pick the strike price very close to market price, don't you have a great input expiring the money and have your stock called? If a put expires in the money, it's not that your stock would be called away, it's that you would be put the shares. Davir asked this question. If you've sold a call and the stock is going up, yes, you have a possibility of the stock being called out. The Tesoro trade we did in February, we do about 1 of these a month. was buy the shares and sell the calls, and if you get called out, fine. We had an over 80%. We had like a 1.8 or 2% return in 2.5 days. So I don't really care. I mean, you can't be greedy. You have to have some discipline. And for people who wanted to roll the shares, roll the calls forward, Tesoro happened to go up from 82 to 92 in 3 days. That's never happened before. And people made a lot of money. But you have to go into a call position understanding if you're going to roll the calls forward if the stock moves or if you're willing to be called out. You do that beforehand. What level do you need with your broker for these strategies? Meaning that there's level 2 and level 3 trading ability. I do it in my retirement account. I don't even know what ability, I don't even know what paperwork I signed years ago. I'm with Options Express. I'm not endorsing, I love them, but I'm not endorsing them. They're now owned by Schwab. The bottom line is each broker is individual, but I'm guessing level 2, maybe level 3. But remember, you're only selling simple puts that are supported by cash or margin. I mean, people use the term naked puts. Ain't no such thing. It's all cash supported, and they're covered calls. They're covered because you own the shares. When you say I own it, do you mean you already own it and that your option buyer put it to you? Bruce, this is Bruce's question. The terminology here in the questions is maybe I spoke too fast during the presentation. If you already owned it and the option buyer put it to you, that doesn't make sense. You're not selling a put on shares you already own. You're selling a call on shares you already own. If you sell a put and you decide to accept shares, meaning the put is it's called in the money, $40 put, $39 strike price, the odds are you will be put the shares. You make a decision to roll or you make a decision to accept. Let's see. Let me go down. Kevin, do you have so many customer clients that the amount of options that are being sold puts pressure on the option? No. I worry about that. I used to run a biotech service, and when we did the little guys, it was a real problem. That was 10 years ago. And I used to do a short service many years ago that was speculative. And in those days, during the great run-up, you'd have 10 times as many calls as puts. So I learned how to be very circumspect. When I spoke tonight about liquidity, part of the decision that I make, if I make a recommendation in my service, and you need to do this on your own, is you have to make sure that there's enough liquidity that if you buy, I mean, I have positions where I have 20 contracts, you don't want to mess up and get a bad price. So the answer is a flat-out no. I've never seen a price disturbed. And in some of my advanced services where we do trading rooms and we do live services, the people know to use limit orders, and they let the market come back to them. They don't chase anything. Technically, all you need to know is buyers. So how I would generally agree that you should not do this less than 10 games. It could be done under 10,000, but you really need at least a $10,000 account. Your results are based on trading one contract. In the slides, there's a mix of numbers. This is Anthony's question. Some of the numbers about what people made on average a week is we extrapolated from doing surveys of what the average account size dedicated to this was in the survey respondent and so forth and so on. In the latter end of the presentation, the numbers used were based on the actual trades in February and what if you traded 3 contracts. It was very, very straightforward. So the $1,397 number was 3 contracts. If you did one, so you divide $1,397, that would be $460-something, $466.60-something, 33 cents or something. Let's see. Edwin Jones is Ed from Austin, Texas, but Edward Jones, the broker, doesn't allow you to trade options. So just thought I would tell you. Let's go back to the top for questions. Let's see. Can you trade? Yes. In an IRA? Absolutely. I think we've gone through most of them. Someone's making comments about brokers. One of the things that happens after training, if you decide to take the service, we have live strategy sessions every month, and they're at night, and people share information about what they think about their broker. And I think, I could be wrong, but I think we now have a list of brokers up on the Options Income Blueprint, not on the website for the training, with different brokers. But I happen to use a relatively high-cost broker. It's still cheap because I love the ergonomics, and it's very critical to what I do. But there are many, many brokers. Forbes magazine and Barron's usually have the two not Forbes, Barron's online typically has the best review of the online brokers. Did you say you only have 11 stocks in your portfolio? You bet. And that's a lot for me. Many, many moons ago when I had brown hair, I got into using concentrated portfolios. One of the things with a concentrated portfolio is that you get to very efficiently trade. You get to very efficiently trade calls. I have a preference. If I want to buy a stock, I always sell it in the money put. I always want a discount to the market. And so I have my own flavor of investing that has developed since the 1980s. The bottom line, and yes, it's concentrated. Question is, are the classes recorded for viewing later on? Yes, everything's recorded. How long is the program for $7.95? I think John can answer that. I think you'll get follow-up emails if you don't sign up tonight. I think it's the end of the week or it's Sunday night or something like that. Somebody made a comment, Michael, I really believe you provide the best service and options out there, but a good-sized portfolio is necessary. I happen to agree. I know that I have successful people in my service, when I'm talking about training now, that have a $10,000 or $15,000 account allocated to this. The problem with a smaller account is you may only be able to do one position a week. Gilead is a $100 put, $100 strike price would be $10,000. And if you end up, like for example, let's say last year you had a $10,000 account, you did the CRE trade. Well, to protect your capital, you'd be tied up in that trade generating smallish amounts of cash for 4 or 5 months. That only happens once a year, but if it's the wrong one, when you have a larger portfolio, or I always recommend you have diversified positions. Sorry to suggest that I'm going to Starbucks. I'm having a cup of coffee after this also. I am holding Calumet, lucky for the high dividend. Calumet Energy, symbol is CLMT, is a refiner in the Midwest that does specialty products, and I think it's grossly undervalued. But it's not a stock you can trade with this program because the options aren't liquid enough. So the vast amount of time are yes, almost all weeklies. The recommendations go out on Tuesday and Wednesday. And some of my advanced coaching services, for example, we put out a trade in the advanced coaching service called Income Masters. We did that. We did for March week 2. We put out a position today. If you were put to shares, would you sell calls while holding the stock? Of course. Everything, and I'm going to wrap up because I think we're beginning to get duplicate questions. Question about rolling, excuse me. You're more likely to end up buying back the put for higher cost than what you sold it for rolling, so I don't see how this is so consistent. I don't get it. You sell, this is a weekly, and let's say you sell a $40 put and you get 50 cents or $50 a contract. Well, you might get more, but let's say it is. Let's say you have to roll it into the following week, and you have to buy it back because the stock is at $39.50. Well, you probably have to buy it back on a Friday for 60 cents. Okay, you're down 10 cents. And then you sell next week's, you're probably going to sell next week's for 80 or $1. Let's say it's 85 cents. You end up increasing your cash. Your average rate of return goes down because you're now holding it theoretically for 2 weeks, but you're actually increasing your cash. This isn't double talk. This is exactly how it works. If you ever became a member, you can check the performance record. With weeklies in particular, this doesn't happen a lot. And what I prefer to do in weeklies is we roll into the next month and then try to buy it back in 2 or 3 days, being in a big chunk of cash, which gives us a lot of flexibility in managing the position. So your question assumed that if I bought it back for 60, I couldn't sell it another one for more than 60, but of course you do, and it just works. It's not. This isn't a pedagogical training person view. This is real world experience, both from the service and from my own portfolio. Michael, what's the story of the 60-day trial you're offering? The story is, I think, I'm not a marketing guy. It's $79. It's up on the website. You can go to the website and find out, or John will answer your question, or call customer service and they'll take care of you. Can you comment on CRE? I had to buy it and holding it now. I think the stock is trading heavy and will trade heavy, bouncing into 40 and bouncing off. It's waiting for earnings. But Wall Street, the reason it sold off was Wall Street did not like that its margins were declining, and then it really broke because during the third quarter, it had an unexpected 19% drop in contract sales of contracts for its core LED technology that gets embedded in phones and tablets and whatever. My personal supposition was that with the iPhone 6 coming out froze all design awards and all sales for new products. Everybody wanted to see what was in the iPhone 6. So that's recovered. They really have a big presence in retail now with LED light bulbs under $10. They broke the price point. Wall Street's finally embracing a more rapid growth of the light bulb business and lower margins, so they've repaired the stock from 29 to 39. It's up it's up 33% in a few months. My guess is once it trades past 40, and it could be the next earnings announcement, it should start climbing back to former levels based on earnings performance and people just liking the stock. It's also potential. This is a 1 in 20 chance, but it's also a potential takeover target. And that's not a rumor. It's just a thought. At these prices, the company's a steal. Anthony, Ron, I have taken the course. It's good for the money. How much is your alert service? $79 for the trial. You will get a special paycheck. I think we're running out of questions. Yeah, it looks like we're out of questions, which is going to be good, and I'll wrap up.
Actually, Michael, I'm back. Sorry about that. Just a quick question. There were a couple of folks who asked about selling options against ETFs, indexes, etc.
Oh, okay. No, I missed that question. Most people own, I don't, but most people own ETFs, and a lot of spread traders and a lot of options traders trade against indices. I don't do either, and the reason is very simple. The premium isn't there. There's not enough premium on most. It's very funny that this question came up. We do live trading rooms in some of my advanced trading services, and I sometimes graft a coaching session on. And this week we're doing one on ETFs because there are now a couple that are in the 20 to 25 to 30% annualized return premium, meaning there's enough premium there. I still shoot for 35 when I'm doing trades and options income blueprint on an annualized return because nobody's investing all their money all the time. So if you get an average transaction, last year was 29.9%, you got to figure that translates into something a little bit lower for someone's income. But the bottom line is with ETFs, it's been too low, but some ETFs related to energy and some related to currencies, which I'm not necessarily comfortable with, but with energy and retail are moving. So you can do this in ETFs. They're big ETFs are very liquid, and a lot of them have weekly options. If you want to get, and write this down, if you want to get a list of ETFs and indexes that have weekly options, you go to CBOE, go to Google, type in CBOE, which is the Chicago Board Options Exchange, but do this in the Google search box. CBOE weekly option list download. And you'll go right there, you click, it downloads a spreadsheet. There's over 400 names, if you want to call them that, and in it is every ETF that there are weekly options. And I don't discuss this in my service. I do answer emails, believe it or not. I'm one of those advisors who answers emails. So if you have questions and you're part of the service, then I do answer questions about ETFs, and I'll even give you some places to explore.
I'm going to take a couple of quick ones, and then I think I'll give you last thoughts, and we'll be able to wrap up here. First from Bruce, is the alert service focused on providing suggestions for options to trade? Bruce and anyone else, you'll have an opportunity to be introduced to the Options Income Blueprint program just after the weekly Paycheck training program. Remember that the weekly Paycheck training program is a standalone, self-paced training module. You'll be able to get through it in about 30 to 40 minutes yourself, all the downloads, all the cheat sheets, etc. It's enough to give you the power to do this on your own. However, you would prefer to have a mentor. The Options Income Blueprint program is a combination of a complete education course that goes above and beyond selling options against just weekly options, as Michael's been talking about here, into the entire universe of selling options, both covered calls, and selling puts on such things as monthly options, selling puts on, he does talk about the indexes and ETFs in that course as well as bear market strategies. It is a 5-module course that covers the entire universe of selling options specifically to generate income. That's the education part of it. The advisory part of it is each week Michael puts out typically about 2 weekly options to trade that week, as he said earlier, typically on Tuesdays or Wednesdays of the week that the option is going to expire is when he will put those options recommendations out. So you're generally in those trades for about 3 days. You'll execute them on Wednesdays and then close them out on Fridays. Typically those alerts will go out in the morning on Wednesdays, usually around 10 a.m., sometimes as late as noon, depending on the market conditions that we happen to have on that particular day. But it gives you more than enough time. He gives you the specific strike price. He gives you the limit order range, so you know exactly where to execute those and how to execute at the best possible dollar amount for yourself, for your income. For your
and if
paycheck.
I may, monthlies go out on an opportunistic basis. I never open up a new position on a Friday, just a personal bias. But if I do monthly alerts, it can be any time from 10 o'clock on Monday until Thursday at 2. All the alerts go out between 10 and 2. John's correct about when the weeklies go out and the monthlies. And, I'd say there's an average of, as we said before, maybe, 8 to 10 trades total a month. And it just depends upon how things are going in terms of the stocks that I like and the way the market is trading.
And then the last question that I'm sorry, just to wrap up with there. So the trial, it's a 60-day paid trial for $79. You can continue on after the 60 days for $79 a month, or we'll give you a one-time upgrade opportunity to be an annual member with a 33% discount. So that you'll see that opportunity to join the trial after you take the $7.95 training course right away. So get the training course, learn how to do this for yourself. It has helped thousands of investors over the last 4 years since Michael originally launched this in 2010, 2011. So the last question for the moment here is from Deborah. And Michael, I'll take this, but I'll let you add on as you would like. She asks, do you have an opinion about the Thinkorswim online tutorials and recorded classes? 2 points to make on those typical those educational pieces that come from brokers. The first thing to understand is that they have to run through essentially not the risk management department, the compliance department. So the problem with most of the online stuff that comes from brokers, the online education that comes from brokers, is it's sanitized. It doesn't really. You'll understand the mechanics of a trade, but they don't and can't give you the next step, which is how to find those trades. They can give you, use this tool, or here's how to use this tool, or here's what this thing tells you, but they can't really put it together for a specific strategy designed around generating income for yourself. Now,
and if I can add to that, if you're looking for sort of neutral, a little bit more informative, the cboe.org has a whole bunch of training programs. They're not like this. They don't have a specific goal in mind, meaning they're more about vocabulary and mechanics, as John said. The Thinkorswim, all the online option broker courses, most of them, really encourage and are designed for people who do a lot of high-frequency trading and day trading because they're trying to increase volume. That's what they're there for. They're not there to educate. They're there to do sales, and I don't blame them. But none of them has a point of view. And to my mind, you don't write a magazine article, even if it's objectively correct, without a point of view. Why bother writing the article? In the training program that's an options income blueprint, which is 5 modules and 3 bonus modules in addition to the trades, there's a point of view, which is you want to generate cash and income, and this is how to do it. As John said, you won't get that from a broker or from the CBOE. The CBOE is high quality in terms of mechanics and vocabulary.
And I think the other thing, which is something that you really can't get. I'm not denigrating the brokers. As Michael said, they do it for a reason. It doesn't make them worthless, and I'm not saying that they are. I'm simply saying that they're grounded, and I think vocabulary and mechanics are the 2 right words to use with them. But the other thing that Michael talked about earlier, which really is the most important part, is about stock selection. And if you join him, if you follow our traders.com site, is a series of trends, and they from year to quarter, but those trends define the best companies to use for the strategy he teaches. That's how he's able to be so successful. It is, as he said, it starts with stock selection. When you have the right name, when you have the right stock, when you have a great company, the demand for that company is going to be substantial. And that demand is what creates the volatility that then creates the premium you need to sort of cash in your weekly paycheck. So I guess to wrap up, Michael, any last statements on stock selection, its importance, and how you go about it?
Yeah, I'll talk about stock selection for 30 seconds and let everybody go get their Starbucks, like someone who said, because I could, it's getting a little late. The importance of stock selection it lays, and it's hard to do this in a 45-minute training module. The entire foundation of selling any kind of option for income rests on two things: your goals. Do I want to do 15% a year, 25% a year, 35% a year? From that, you have one leg of the stool, so to speak. The second leg is your stock selection. The third leg is how you personally are capable of trading. It's a whole other story. Stock selection, when you believe in a company and stock, it makes it easy to roll. It makes it easy to accept shares if you desire to. You don't have to, and then sell calls. It gives you the ability to be aggressive. It gives you the ability not to be terrified of being too close to the strike when you sell a put. When you have that level of comfort and knowledge that the company is good and the stock is good, you can be very aggressive and hit those very aggressive goals. And just to wrap up, and then I'll shut up, I get emails every day. Why don't you do this stock? GoPro and this. I don't do momentum stocks. Momentum stock is a piece of bad news. The stock loses 50% of its value. And you can't do a put selling strategy with that kind of capital risk. So bottom line is stock selection is one of the three legs of doing this for income. It's absolutely critical, and you'll hear more about it depending upon what you decide to do after tonight.
Thanks, Michael. And TC, I just put an answer to your question in the chat box there for anyone else who needs it. The best source for evaluating online brokers, whether it's for stocks and or for options, every year, typically around March, Barron's Online publishes their broker evaluation guide, or their broker review, if you will, and they rank the brokers. If I remember correctly, 2014's top broker for options was Interactive Brokers. That's interactivebrokers.com.
Yes.
So, I'm sorry. Go ahead, Michael.
No, I agree. It was Interactive Brokers, and one of the most expensive, which is the one I use, was rated #1 in ergonomics, which is why I use it, and that's Options Express. So there's a whole range. They have check boxes telling you what the sites are particularly good at. It's not just one number.
And finally, Anthony, you are absolutely right. Michael teaches you how to fish, from stock selection to the right option to the right trade strategy or tactic to generating those goals to generating the income. He's teaching you how to do this yourself, and rather than just giving you the fish. Now, the advisory part of it, of the Options Income Blueprint, that is giving you the fish to use with the strategy. But he's giving you only a few fish a week, but he's also teaching you how to do this yourself, and you'll become your own expert over time. So with that, folks, I think we'll call this ball game, since as we talked about at the start before everyone was on, baseball is back, baby. So Michael, thank you for talking through the bunt, single, single, walk, single, bunt approach of the weekly option strategy. And
thank you, John, too, and thank you everybody for coming.
Absolutely. Thanks, folks. Have a great night, and there will be a replay email out to you folks within the next hour. We're also going to let those of you who are here, as soon as we end this, we'll forward you to a video that you can follow on, watch, which kind of recaps some of the core concepts that Michael was talking about here. So thank you all for your time tonight. We look forward to seeing you again and or in the training program and in Options Income Blueprint. For everyone here at Traders Reserve and Options Income Blueprint, and for Michael Shulman, my name is John Hutchinson, and I'd like to thank you again for your time tonight.